2025 has begun. Hello everybody, I'm Kevin French from Core Wealth. We're going to be talking about 2024, just how the year finally ended in December and what it looked like as a whole. And then we'll have a look forward and make some comments around what we expect for the coming year and future years ahead. The second biggest economy in the world, China, ended the year last year at close to 5% growth. The numbers have come out just recently. And this was after lots of negativity and different concerns happening during the year. The Chinese government has committed to trying to get that economy growing even faster into the future. They have raised a lot of debt. 3 trillion won's worth of government bonds have been issued, and they are looking to spend that into the coming year to try and get the local economy growing even faster. On the back of this, we actually saw the Chinese stock market not do too badly last year, almost 15% up for the year, despite being a little bit softer at the end of the year. On the other side of the world, in the United States, we saw another interest rate cut over there, but the Federal Reserve, in the announcement of the cut, was quite hawkish or conservative in their comments. And looking forward, there's only an expectation of a 0.5% interest rate cut for 2025 in the US. This caused US bonds to actually their yields to go up, and when that happens, their value goes down. So bond markets in the US on the back of that were not a great place to have been last year. So let's have a look at commodities, and starting with Brent crude, which was slightly higher at the end of the year in December, was up to $75 a barrel, but that was still softer or lower than where it started the year. If we look at industrial commodities, things like iron ore were softer, and this was on the back of slower demand coming out of China. But the place to have been from a commodity point last year was gold, which was up over 20% for the year and giving a nice return to some of the gold mining companies. Currencies have been really interesting, moving not necessarily in tandem over the last year, even the last 3 years. And what we've seen from South African investors' point of view, looking at the rand, December was a particularly tough month for the rand, and against the dollar it weakened quite considerably. But if we have a look at it over the last year, it was actually one of the best performing currencies against the dollar in 2024. So the next couple of slides, we're going to dig down into the different markets around the world, how they've performed both locally and internationally. So let's start with just looking at the month of December. You can see all of the figures red there, implying that all the markets were down. Some were down less than others. Global property was not the place to have been in December, down over 6.5%. But then looking further down, US equities down 2.4, UK equities down 2.7, and then other global equity markets down a lot less. So the place to have been in December, places like Europe and Japan and Chinese equities. But now let's have a look at the year as a whole. We can see that the US was really the place to have been, up 25% for the year. And this was really on the back of, again, the Magnificent Seven just responding extremely well to the interest rate cuts that happened in the second half of the year. But Chinese equities up almost 15% for the year, and then the other equity markets, very average returns. UK up just under 8%, Japan just under 9%, and emerging markets around 7.5% for the year. So looking at the South African equity markets and bond markets, we can see that in December it was a bit more of a mixed bag than it was globally, although equities and bonds were down, but the listed property market in South Africa was up. And speaking of listed property, if we look over the 1 year, listed property was really the best place to have been last year, up 29% for the year. The South African equity market up 13.4%, which is a reasonable return. Our bond market actually outperforming the equity market and up 17.2%. We saw that the US dollar strengthened against the rand for the year as a whole by some 3.2%, but the rand actually strengthened against the euro by 3.3% and was only slightly weaker against the pound at 1.4% for the year. So let's look at how that's translated in our global models that we run for clients. And this first slide just shows you how we've done. Again, the shaded parts green, meaning we've outperformed our peer groups. And we can see over most periods we've done that. The last year's returns were quite reasonable and outperforming peers in our defensive and balance strategies. The growth strategy slightly underperforming the peer group, but still giving a 10.4% return. That underperformance was mostly due to our valuation driven strategies. Growth strategies performed a lot better during that period because interest rates came down, and also that you had to be in quite specific stocks in the US to get those returns. But we're quite happy with the longer term still outperforming our peer groups in our UK models. This next slide moves on to the US dollar models. And here we can see over the last year, from a relative point of view, our returns, we've seen our defensive strategy and our global growth strategy underperform. But despite that, the longer term numbers still looking good, particularly over 3 years for defensive and balanced. And all of them outperforming since inception. Again, the reasons I gave earlier for the underperformance, the fact that we have more valuation driven strategies hurt us in the shorter term, and the fact that you had to be in specific stocks in the US which are quite expensive, actually meant that we saw some underperformance in the 1 year numbers for our US dollar strategies. Let's have a look at our local or South African models for the South African client base. And here you can see that last year again was a very good year in absolute terms, returns varying between 11 and 14%, and a lot of green there, showing some good outperformance of our peer groups, other than our balance strategy just basically being in line with peer groups. But the absolute return's really good. What for me is pleasing, if we look at the 5 year number, if we take something like our balanced and retirement growth strategies, 11 and 12% respectively, that is in a period where inflation was at less than 5%, which means that you had returns above inflation of over 7%, which is really, really attractive and means that clients' wealth has grown quite nicely. What's also very pleasing to see is our since inception performance. We're investing for clients over the long term, and all of the models have outperformed their peers annually since inception, and this is particularly pleasing given that we're heading now for 13 years of that outperformance. So let's have a look at what we're expecting from inflation in the future. Here we can see inflation over the last while has been coming down nicely in Europe, in the UK, and in the US, but it's now started to go sideways for the last little while. And one of the concerns has been that it is not going down any further, and therefore interest rates won't come down as much. And on the graph on the right hand side, you can see that the expectation at the beginning of 2024 was that interest rates were going to come down further than they are. That's the lower dotted line in each of those graphs. But the solid line shows where interest rates have actually gone, and they haven't come down as much, and nor are they expected to come down that much further into the future. And this has meant that perhaps the returns on some of the equities, particularly in the more growthy stocks, will not be as much as what we've seen in the past. So what does the US look like at the moment? Had a really good year. The S&P 500 was up 25% last year, but at the moment the top 10 shares make up 36% of that market. That's the graph on the left hand side. Since 1980, having the top 10 shares as such a high percentage has never happened before. And then on the right hand side, we just show that when shares are at different valuations, what are the following 10-year returns. Now this is looking back, and we can see that when shares are at the current valuation, that shaded line, the next 10 years returns historically have only been just slightly above zero. So it is a concern for us that there's a number of stocks in the US that are really expensive, and so we're looking for good stock pickers going forward. We mentioned in the introduction that China had grown at somewhere around 5% for 2024. We think this is a good level of growth, but it's not been without its challenges, and the concern is that the consumer is slowing down in their spending in China, and therefore economic growth will slow. One of the indicators of that slowing demand is the fact that inflation becomes really low, and at the moment this graph just shows you inflation going back. The blue line is consumer inflation, and that's currently only at 0.1%. The red line is actually negative. That's producer inflation, so manufacturers, their inflation level is actually negative. So this is a concern we have in China, that hopefully the stimulus we spoke about will ignite and trigger further demand in China into the future. So China, if we have a look at their growth looking back, and you can see on this graph it goes all the way back to 2000 again. Currently the expected growth for 2025 and 2026 is now slightly below 5%, and we're expecting 2024 to actually come in at around 5%. But 5% is a really good growth in absolute terms, and that is the second biggest economy in the world. But compared to its history, it definitely is slowing down, and hence the world is looking to see whether the stimulus that the government applies will actually result in further economic growth. We'll close off just by contrasting the Chinese situation with the South African one. And on the graph on the left hand side, we've got the same data, in fact, that we had in the previous graph. going back to 2000. The blue lines are Chinese GDP growth, and we can see that that GDP growth is gradually reducing, although it's still at a very high level at just under 5%. And then the green lines are the South African GDP growth, and we can see that that's a lot more cyclical, goes up and goes down. But while Chinese GDP growth is gradually reducing at the moment, the expectations are for South African GDP growth to be positive going forward. And then on the right hand side, we've just shown some South African stocks, some of the quite a broad array of stocks, but comparing them to the all share index, and we've compared them in dollars and in rand. So the dollar return is in purple and the rand return in green. But what you see there is that if you're a good stock picker and you can find good companies, even over a long period of time, you can get substantial outperformance of the market as a whole in either local currencies or in a hard currency like the dollar. And so we believe that there are some good opportunities facing South African investors in the coming years, as there's more of a tailwind in terms of economic growth and some good opportunities to be found. Thanks for your time in watching this. Hopefully you've got some good insights into what happened last year and some ideas on our thoughts for the year ahead. We hope you have a great 2025. If you've got any questions around your financial planning, please get hold of us. From me, Kevin French at Core Wealth. Thanks for watching.